Hey there, we are live. Thank you so much for joining me. I took a week off from the live stream. Last week it was Passover, going into Easter. Took yesterday off. Um, just had some stuff to do. My youngest got his driver's permit yesterday, so we went to the excuse me. We went to the DMV. He passed. He got his permit. So after this, I'm going to run out of here. We're going to go on a little drive for the first time. I'm willing to take advice from anybody. I'm sure I'll be grinding my teeth a little bit, but he's a good kid, and I think he'll be a terrific driver. But we are going to practice a hell of a lot and teach him little life lessons as we move along. A couple of things to get into. The stock market. I know we focus on the stock market, but I do want to hit on some personal finance stuff first. But I'll just say this. The stock market's waiting for this magic signal. Tomorrow morning, we're getting inflation figures coming out. So one of the inflation figures we're going to see tomorrow is the CPI, Consumer Price Index. Thursday, the Producer Price Index. And if we see a little moderation in inflation, we could maybe start to feel like the Fed is done raising rates. That's what we're hoping for. That's like what the market wants. Look, I'm not hoping for something from the market or from an economic statistics. I wish I didn't say that. I'm really not. Because hoping for things that you have no control over, I hope we get a good number, I hope it goes up, that's not good enough. We're investing for the long term, but your retirement, your lifetime accumulation of assets is riding on the stock market. A lot of nuance, a lot of statistics. But then I step back and I say, ooh, that's a lot of pressure. What is your asset base, your investments really riding on? It's riding on something that actually is in your control. And that's time. That's patience. Your patience is a matter of your control. And given time, companies grow, prices go up, asset values go up over time. That's what you're betting on when you're in the stock market. You're not just betting on a stock. You're not just betting on Apple's new iPhone. You're not just betting on Boeing's new airplane. You're not betting on, Procter & Gamble's new fragrance-free detergent. You're betting on time, that prices go up, that corporate managements will do what they can to manage their businesses as efficiently as possible. You're betting on inflation. Look, if there's no inflation, prices don't go up. If prices don't go up, assets don't go up in value. What companies charge you for their products, if they don't go up, then everything stays the same, and you don't make any money in the market, and you don't need to make any money in the market, right? Because all you have to do is save. The reason just saving money for long-term goals is considered inadequate, and I think history has borne this out, is because inflation grows faster than what you can earn on your savings rate over time. So what goes up above and beyond inflation? Stocks, real estate. I guess you could point at gold. I don't know. Sometimes it does, sometimes it doesn't. Art, fancy cars, stamps, you name it, okay? But that's what we're trying to do. Now, the stock market is very institutionalized, so that's where we focus on it. I don't have the stamp channel, although there are plenty of YouTube channels you could watch about collecting stamps and comic books, and they're wonderful. People collect guns. People collect all kinds of things. People have reasons to be in these things. They feel they know them. They're confident with them. I have friends who just collect cars. It's not my thing, but I'm in the stock market. Stocks are my thing. I like the things I like about stocks is that there's people who manage them. I think it's interesting how the personalities of the people make companies work, how someone could be so skilled like Bob Iger of Disney And yet some managements are so bad at what they do, like the people who manage Silicon Valley Bank, for example. So this is what makes it interesting. It's the people, it's the personalities, it's the strategies, it's the management expertise. And then what happens is people make manage these companies. They make products that you need, that you want, that make your life easier or better or more cost effective, something to benefit you. And these companies bring in revenues, they bring in customers. Hopefully, they reinvest in research and development. Stocks go up, asset prices go up. I have friends and clients who consider real estate the best investment. I'm not knocking it. It works for them. And because they believe in it so much, they tune everything else out so they're not distracted, so they can put their energy into what works for them. That's really important, putting your energy into what works for you. Okay. If you're always wishy-washy stocks, real estate, you're going to wind up never really fully committing to anything. And as a result, the long-term returns get away from you and you're behind the eight ball. So if you believe in something, go for it. Okay. That's what I say. It's your life. I'm not here to tell you what to do. I'm going to roll the introduction. We'll talk quickly about the stock market, a little bit about Social Security, which is just a huge topic. And here we go with the intro. Stick around. We're going to be quick because I do have to, get out of here right after this. While you're watching, if you don't mind, give us a thumbs up, a heart reaction, depending on which social media platform you're watching from. Share with me in the comments your favorite emoji. I'd love to see that. Let me know where you're watching from. And of course, if you have a question about what we're talking about tonight, personal finance, whatever, if you're watching in the live stream or in the replay, ask in the comments. I love hearing from you. I love talking with you, and let's do that. So here we go. Thank you so much for joining me. Jerry, I see you out there. Good to see you, my friend. We need to catch up. All right. So what are we talking? Oh, yeah. Let's do a little personal finance stuff too. Social Security. Now I'm 55, so it's definitely something that pops into my mind because you have to start thinking at my age, you're right, you should be, about what's ahead, right? And, I have a client who he's about to be 70 and he's going to collect Social Security. And he's like, he said to me, I didn't realize I was going to get this much. I thought I was going to get like 35,000. He's getting 55,000. Well, because he didn't factor in the last 2 years of COLAs, cost of living adjustments. And you know what? 55,000 for a guy with a pretty nice net worth who doesn't need it, right? But that's a good chunk of dough. I mean, hey, how would you like to lose $55,000 a year of income? That's okay. That's a lot. Okay, even for my big shot, so my clients were big shots, right? It's something that's nice to have. How do you look at Social Security? So this is how I talk to clients about Social Security because I think it helps set the the neural pathways to make the decision. If you think about Social Security as something you're investing in, you say, well, I'm 62. I could collect now. I'll get a much lower benefit, 40% lower benefit than if I wait till 67, full retirement age. And if the years from 68, 69, and 70, if you wait to those years, you get an automatic 8% increase in the benefit. It's 24%. Plus, you get those cost of living adjustments. So it's a really big difference. But you might be thinking, well, what if I don't live long enough to collect it? What if the average length of American male is like, 72, 74? I forget the exact number. So I might as well collect it now. And if I exceed those years, it's a bonus. And I'm glad I collected. I don't want to take the risk of not collecting enough. I want to make sure I collect at 62. The other thing is if you want to wait till you're 70 to collect, or at least 67, if you're born 1950 and after, your FRA, full retirement age, is 67. So, what if you want to wait? I look, I deal with retirees all the time. I speak with people, what works, what doesn't. I have so many clients who are successful, who still work in their 60s and 70s because they want to, because they believe it keeps their mind sharp. They believe it keeps their their life better, their quality of life. So it's not for everybody. Don't think that like everyone wants to just call it quits at 64 and chase a golf ball. It's not for everybody. In my office here, there are people over 70, over 75 who are brilliant, who live wonderful lives, who could afford to play golf all day. They work, they love it, and that's what they do. It's not for everyone, but you need to keep your mind active. But that's a story for another day. There's an article today on CNBC about a doctor. He's 100. He's the oldest practicing doctor in America. And he teaches, he practices medicine, he writes papers, an incredible super ager. And he says he wishes he could tell you the secret, but what he did is he exercised, he ate healthy, not everything in moderation. He said he still enjoys a martini and a steak, okay, but everything in moderation. The exercise was a big part of it, he feels, but he feels that because he worked, because he teaches, he's involved in the world, in his social life. He says that's what really keeps his mind going. Now, some people just are not as lucky as this fellow. This fellow is obviously very lucky, a super ager. However, having said that, there are so many benefits to keeping your mind active. And everybody says they're going to take all these vacations and travel and read all these books and go to all the plays. I have news for you. Most people are very gung-ho about it. Very few people do all those things. They just don't. They kind of fall into a routine. Their day gets taken up by minutia, running to the store, sleeping a little bit later, taking care of the house. Just minutia. Just they don't get out. It just your life gets filled up with stuff. Believe me, if everyone had an extra hour in the day, that time would just get filled up immediately by more minutia. All right. I'm just throwing you my opinion of what I see in my real world practice. All right, so Social Security. So I've advised some clients to say, hey, if you're going to take Social Security at 62, maybe wait till you're 67 and take some money out of your IRA to supplement you to collect the higher Social Security benefit. And they could say, well, if I die before then, my family just have less money. Well, what's it about? See, some people have that thought that got to leave everything to the kids or as much as possible. Some people have the thought that I just don't want to be a financial burden to my kids one day. And some people just don't care. It's all for them. And that's the end of it. It's their business. We're not here to judge. Okay. Your adult age children should be independent anyway. So it depends how you look at it. Another thing is, do you look at Social Security as an insurance policy? I personally, my view is that when I'm 70, I like the idea of knowing that I have a minimum, I have something else coming in if all else fails. I don't think all else fails, but I have that extra Social Security, and I'm 55. So by the time I'm 70, 15 years, that Social Security is probably going to be closer to $80,000 a year, maybe more. So to me, that's more important to me, whether if I die at 72 or 75. I don't know. We don't know these things, okay? But it's more important to me than trying to collect as much as I can between the ages of 62 and 69. But you have to have your own opinion. So I just want to give you the right conversation, the right tools to think about it in terms of what's best for you. That's all I'm saying. So that's how I think about Social Security. Now let's talk about the stock market. Let's get into the market. Let's see if I could cut to screen 4, pop myself up here. Let me get rid of the social media icons. So the Dow was up over 100 yesterday. It was up 98 today. NASDAQ was off a little yesterday. It's down 52 points today. Nothing huge. S&P 500 basically flat, down 0.17%. It's so little, it's unchanged according to CNBC. Gold continues to stay a little bit above 2,000. Oil, it was trading around 80 about a week and a half ago, if you recall. OPEC said they're going to take 1.1 million barrels off the market. Oil shot up to about 80, finally broke above 80, $81.41. We'll see. I mean, I just filled up my tank, my car today, and it was a couple of bucks more. I'm sensitive to these things. I notice these things. I have a hybrid, so I really like to squeeze out every bit of mileage I can get. I get a kick out of it when I could do it. Just, I don't know, kind of nerdy, I guess, or in a way I'm turning into my father, but it's fun to me. Okay. 10-year yield, 3.428%. It was just 3.28%. So yields are going up a little bit. The VIX is still in the 20, still, I would say, in complacency territory. So what's going on with that is this. Bond yields dipped a lot when Silicon Valley busted up. If you recall, that was March 10th on a Friday. Today's April 11th. So a month and a day ago, Silicon Valley Bank was put out of its misery and taken over by the FDIC. All depositors are insured, no matter how much money they have at the bank. But it plunged oil down to like 66 and the 10-year yield down to 3.2 and change. Oil is now 81. The 10-year yield is back to about 3.4, almost 3.5%. And the bank stocks have recovered a bit. So a lot of things have changed in just the last couple of weeks. It's more like a lot of movement. It's kind of like things were here, they went down here, and they just got back to where they were a month ago. And we've basically skipped over that. We're waiting to see what the inflation figures are tomorrow. Don't hang your hat so much on this. I mean, if we get a low inflation figure, you could see the stock market spike. And people will say, the Fed's not going to raise rates anymore. But 2 or 3 days later, we're going to go back to the same questions. Maybe the Fed will continue to raise rates. They really don't want to have a repeat of what they did in the 70s, where they raised rates, inflation went down, the Fed eased off, then inflation went up, and it just became harder and harder until Paul Volcker came in and raised interest rates a lot and held them there for a while until inflation went down. I have a different opinion about Paul Volcker, and they say Volcker broke the back of inflation. He broke the back of inflation. I have a different opinion. 1980, when Paul Volcker was jacking up interest rates to bring down inflation, there was also the year that offices started adopting the use of the personal computer, which ushered in a massive wave of productivity that went on for decades and continues to go on. Well, now we're all about connectivity with the internet and cloud computing, all instantaneous communications. Nobody waits anymore for a search query. That, I think, is what really brought down inflation, the technology. I don't think throwing the economy into a recession did it. It did it temporarily, but what kept inflation down all these years was this massive productivity boom that we had from 1980 till now. That's what kept inflation down. I don't think it's all about interest rates by a long shot. I don't think that. So I'm not saying that the Fed wasn't too low for too long with interest rates and they printed too much money. Yeah, that helped bring about inflation. And taking that excess money out and excess speculation out of the market, making credit harder to come by making it more expensive. You see how mortgage rates have doubled, right? That will help bring down prices and slow down economic activity and cause some pain. But much better to have greater productivity than pain. So we'll see what the next big productivity cycle is. The cloud is still, believe it or not, cloud computing is still pretty new. The use of AI is cloud-based. Like you don't have AI on your computer. You go onto Microsoft's computers, onto their servers at their server farm, which is the cloud, and you get to use their computers for mining Bitcoin or using AI for tools to build your business or to start a new business. It's going to be very exciting to see all the new businesses that arise out of the new AI tools from Microsoft and Google and other companies. Okay, so mortgage, let's take a look at bond yields real quick. We're still getting 5% for 3 months and 4 months, almost 5% for 6 months. And it starts to go down to the threes again when you get down to the 10-year and the 30-year. All right, so interest rates have not really moved much. We're kind of back to where we were like a month ago, maybe a month and a week ago. And I just want to take a look at this. The 30-year fixed 6.52%. That has not come down. I would have expected that to be below 6, but we're gearing up now for the thought was that the Silicon Valley Bank, the bank debacle, was really much worse than it was, and it's going to throw the economy into recession. I said right here that we'll get through this, and it's a big deal, but it's not bringing down the economy, but not by a long shot. And here we are. So we're waiting for the inflation figures to come out, and people could get all excited about them, and the market could go up, and the Fed could be put on pause. And then we start to worry next week about something else, and we're back to the worries. There's not going to be some magical statistic that gets us back into a bull market and everybody's happy again. It's just not going to happen. It's going to take time. It's going to be a real grind. That's what I call this market for the next couple of years. I think it's going to be a grind. I think you're just going to have to see your account flat, up a little, down a little, and you're just going to really have to recommit and reinforce your belief that you're investing for the long term. Because anything else, you're just going to give up and lose patience. That's what I think we're going to be in for a long time, couple of years. I've seen strategies, dividend plays, low PE ratio plays, all that. And all of these strategies work for a little while until they don't work. But nothing beats diversification, growth. Growth does solve a lot of problems, okay? Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from a generally down market. It doesn't protect your portfolio from going down in a generally down market, and you can't invest directly into an index fund, but you can invest in a security that tracks or mimics an index fund. Okay, that tracks or mimics an index, excuse me. All right, I'm getting out of here. It's been 21 minutes. It's been a lot of fun. Great to see you guys. Great to be back. I was out for a week from the live stream. I feel like I haven't done this in like 3 months. So weird, just a week, And I'll be back tomorrow, and we'll see what the inflation figures are. I have a radio show. I go on at 9:07 a.m. till 9:30 a.m. on 103.9 FM in Long Island. You could check it out on their radio app, LI News radio app. But you could also check out all the episodes on my YouTube channel, Client First Strategy. And it's good stuff. It's a live show. You never know what's going to come out of my mouth. But it's really, I really am enjoying it so much. And I hope you'll take a listen. And I'll see you tomorrow. Thank you very much.